Welcome to Gen Z Money, episode 36.
So the one thing I can tell you is the costs vary dramatically across the country. They really do. I can tell you, I can promise you, every single person that works on your file with doing their specific part in making sure that this is a good mortgage, every single one of them gets paid, and you pay them one way or the other.
Even if my jokes aren't funny, my tongue tied up on it, and I don't need to speak a single word, 'cause you got me holding.
What's going on, guys? Welcome back to the Gen Z Money Podcast, where we turn financial peace to your reality. I'm your host, James Bowman, and today I bring on Casey Fleming, who is a mortgage advisor. Guys, I told you guys right after that home buyer episode that I was going to have an episode specifically for applying for a mortgage and getting a home loan. Guys, we go into so much depth on all the different terminology when it comes to getting a mortgage and what they're looking for and tips to get you guys approved. I mean, we cover all types. We cover down payments. This guy wrote the book. He's the author of the loan guidebook, how to get the best possible mortgage. So there is just no better person to bring on to have this conversation. He was so knowledgeable. We go into all the different technicalities and everything. So when you guys listen to this episode, you are going to have every tool in your arsenal to now go out and get pre-qualified or pre-approved for your first home. So I really hope you guys get a lot from this, and we're going to throw a lot of information at you guys, but hopefully you guys are able to consume it all. You might have to listen to the episode 2 or 3 times just to make sure that you're getting all of the information that we're throwing out. So I really hope you guys enjoy. I hope that this helps you guys purchase your first home. But without further ado, guys, let's go ahead and jump right into the interview. Casey Fleming, welcome to the Gen Z Money Podcast. Man, oh man, is this a much anticipated episode. I really appreciate you coming on this afternoon and sharing all of your expertise when it comes to mortgages, buying a home, and the lending side of things.
Thank you very much, James. I'm excited to be here for you.
For those who do not know, this is Casey Fleming. He is a mortgage advisor for Fairway Independent Mortgage, and he's an author of a book, The Loan Guidebook, How to Get the Best Possible Mortgage. And he also has another book, which I'm sure we're going to get into a little bit later in the podcast, titled Buying and Financing Your New Home, that's going to be coming out in August. Does that sum up a broad view of you, Casey?
Yes, it sure does.
Awesome, man. And so we already went over some things, and for the listeners out there, this is really, so I did a podcast episode specifically on how to buy a home. And quickly I realized that buying a home and getting a mortgage should be 2 completely different episodes, because they are truly 2 different beasts. And although I've purchased a couple properties, I'm no expert, and I still have questions from time to time. So it's great to have what I would call an expert on to shed light and not just me talking in the thin air, man.
Excellent.
So let's get down to I want to break it down to the pure basics. This is a beginner's podcast. Let's just talk about, when buying a home, what is a mortgage?
Well, very simply, a mortgage is the financing to buy the home. And when you get a mortgage, you pledge your home as collateral to the lender, so that in the event that you aren't able to make the payments, they can take the home from you in order to be repaid back.
Gotcha. So it's a little bit different because, they have auto loans and we have credit cards. And for example, an auto loan is leveraged against the vehicle. So the mortgage is the same way, where it's leveraged against the home. And if you don't make your monthly obligated payment, the same way they'll come repo your car, they'll also come and repo your home, essentially. Is that right?
Yes, precisely.
Okay, so let's start. So, boom, we know we are purchasing a home, and I'm not big balling like that. I don't think most people are big ballers. So, we know we have to get a mortgage. We know we have to get a loan. The first person that they need to be contacting for this is a mortgage broker. At least I suggest a mortgage broker. Can you really quickly define what a mortgage broker is?
So a mortgage broker is simply somebody that you go to who can shop many different sources for your mortgage. It might be, depending on the broker, that might mean they can shop 6 different lenders. It might mean they could shop 100 different lenders. It just depends on the size of the brokerage.
Awesome. So we actually did an episode about insurance a while back, and we talked about insurance brokers to where they're not tethered to one specific insurance company. They can shop along other insurance companies. That way you, the customer, get the absolute best deal out there. So it sounds like it's the same thing for a mortgage broker.
Yes, it is.
So let's talk about, before we get to the mortgage broker, right? There's two, we're always saving money because, for the most part, in 90% of cases, you need to have a little bit of money to purchase a home. Now, we're going to go in a little bit later what that amount is, but there's 2 separate parts of buying a home with financing, and that is the down payment and the closing costs. So for the down payment, can you explain, why do we even need a down payment? Like, if we're getting why doesn't the bank just give us all the money? Because when we go to a car dealership, they give us all the money for the car. We might have to put no money down. So why do lenders require a down payment to get a mortgage?
That's a great question. First of all, it is a much larger loan, especially if you're in my area where tract homes cost 1.4, $1.5 million. So the bank is going to lend you more money than you've ever borrowed before in your life. As a result, they want to make sure that they're going to get paid back. So one way or another, they do everything they can to mitigate the risk of losing money on your deal. You have to remember that mortgages are very, very inexpensive compared to other types of borrowing. So they really have to mitigate the risk to a very fine degree in order to be able to make loans at such a low interest rate. With conventional financing, you can get in as low as 3% down on a loan we call it a conforming loan that conforms to Fannie Mae or Freddie Mac standards. But when you put the lower down payment down, they have other ways of mitigating the risk, like using mortgage insurance or a guarantee from the government. So one way or another, they want to make sure that their risk is as low as possible. And if you put 20% down, the reason that's when they don't require mortgage insurance or anything else is because you have a lot of skin in the game. And statistically speaking, when you put 20% down or 25% down, if things go wrong, you're very unlikely to walk away from that down payment. You'll figure out a way to make the payments.
Yeah, I love that, man. I love how you phrase it. It's your skin in the game. And
Right.
another portion of it, especially when we talk about putting 20% down, let's just say you don't make the payments. A lot of people think that banks are in the business of, oh, I'm going to take your home if you don't make the payment. But let's be honest, the banks don't want your home. The last thing they want to do is take control of your home because now they have to sell it. But with you having 20% equity, in a sense, hypothetically, they could sell it for a 20% loss and still break even. So that's another way that they're protected when it comes to this. And of course, if there's a market downturn or equity shifts, then they might not get that privilege. But it's just another way to look at it, of them protecting themselves from getting taken advantage of. But really fast, you mentioned mortgage insurance, which I think is a big proponent when picking how much down you plan on putting, how much of a down payment you plan on putting when purchasing a home. So this comes in, they have two different names for it: PMI, private mortgage insurance, and MIP, mortgage insurance premium. And I believe that the different loans have the different names. But Kevin, real fast, can you just describe what that is for the listeners?
Sure. So a mortgage insurance is simply an insurance policy that the lender puts on your mortgage that protects the lender. If you fail to make your payments, and if the lender ends up losing any money as a result of having to foreclose on the property, after they have foreclosed, the mortgage insurance company will reimburse them for their losses. So it's an insurance policy where you pay the premium, but the beneficiary is the insurance company.
Gotcha. And so let's just relate it back to the example that I just made, where let's say you put 20% down and unfortunately you can't make your payments. The bank takes possession of your property and they have to sell it for a 20% loss. Well, there is 20% less. There is no loss on their books. But let's say you put 3% down and they have to foreclose, take the property back and sell it at a 20% loss. That private mortgage insurance is going to step in for that 17% difference, and they're going to pay that to the bank. Is that correct? Is that summed up pretty well?
That's correct. There's intricacies, but that's the basics of it. Yes. They cover some or all of the loss, depending on the policy.
Gotcha. I really want to break this down to the bare bones. I want to answer any questions that I think people would pose I want to break it down to the basics. So I really appreciate you breaking it down. And then the other portion of money needed to purchase a home and to get a mortgage is closing costs. This is the one that not many people talk about, not many people know about. And when they get that initial disclosure, they're like, oh, what's this? So Casey, can you real fast go over what are closing costs and why are they even a thing?
So closing costs represent all of the work that everyone does on your transaction. So when you go to get a car loan, really you've just got a bank loan officer that says, yeah, that looks like a good deal. And it's 10 minutes worth of work and they're done, right? They run your credit, that's it. With a mortgage, it's very different for a lot of reasons. The main reason is this such a large transaction. But also, we have to make sure that whoever's selling the property actually owns it and actually has the right to sell it, that there aren't any restrictions. We have to make sure that the mortgage is properly collateralized with the new property. We have to make sure that the value is there. So think about everyone who gets involved with your loan. And we're not all at the same company, we're at different companies. So there's a loan officer who's going to get paid. There's someone who processes your loan, which means they gather all the paperwork and put it together, assemble a file in the proper order and make sure that all of the data in the file is correct. There's an underwriter who goes through and double checks to make sure that your loan request meets all of the conditions of the guidelines that the lender has established. There's an escrow company that has to gather all of the documents and all of the money and disperse everything exactly according to instructions. So they're an independent third party, completely disinterested. There's title insurance to make sure that you're buying what you think you're buying, right? So that you're buying the property you think you're buying and that there aren't any liens on title or clouds on title that you don't know about. There's also a lender's insurance policy that ensures the lender that they're properly collateralized. The government is going to, almost everywhere, charge some sort of transfer tax, and they're going to be recording fees because everything is recorded at the county level so that they can establish the true ownership of every single property. And a good metaphor for that today is blockchain technology, where we need some sort of central repository to make sure that you really own it, right? And to define what you own. The county recorder is the brick and mortar equivalent of the blockchain technology. So there's that. So there's all these people that get involved. In many states, an attorney has to review the paperwork. In many states, the property has to be surveyed every single time that you have a transaction. So all these people get involved and all these people get paid. I promise you they all get paid. So it can show up in different ways, and that's where it gets very confusing to the consumer. People will ask, well, what do you charge for an origination fee? And a lender might say, well, we don't charge anything for an origination fee. Okay, that's great. But it turns out they charge an administrative fee. It's just a different name. Or maybe they don't charge any fee at all, but they build the cost into the interest rate and they make a little bit more money on the back end because they've charged more for the interest rate. So the one thing I can tell you is the costs vary dramatically across the country. They really do. I can tell you, I can promise you, every single person that works on your file with doing their specific part in making sure that this is a good mortgage, every single one of them gets paid, and you pay them one way or the other.
Even the people who watch you sign the documents.
Even the people who, at least you know what they're earning, right? That's a line item. You have a notary fee. That's a line item. You know, if it's $175 or $200 or whatever it is, at least you know it, which is cool. I think, you know, it's like people get frustrated because there's so many line items. And sometimes they lose sight of the fact that the only thing that really matters is your total costs. So some lenders have a strategy where they minimize the number of line items and they'll group costs together. They'll bundle costs into a single line item like an administrative fee. But the administrative fee, I mean, you don't really know who administered what. So as a mortgage advisor, I kind of like it when we have all the individual line items, because I can say, well, you know, you got an appraisal because you have a report, and this is what the appraiser charged. And you know that you had a processor because you got to speak to him or her, and here's what they get paid. So I kind of like having all of the different line items myself, but it does frustrate people because they just take a look and there's a million line items and they get ticked off.
Yeah, I 100% agree with you. I like also seeing the breakdown. A misconception that I'm really glad you disproved off the rip of this is that a lot of times they'll say, oh, your closing costs won't be more than 4% of your loan or 6% of your loan or 3% of your loan. And really, there is no rule of thumb when it comes to closing costs. Now, I would say, 6% of your purchase price or whatever the case is. The point is, there is no rule of thumb. Now, there are maximums. Like if you're paying 20% of your purchase price and closing costs, you might want to see something. But to penny pinch it, there's a better use for your time. And I'll just use, for example, I signed an initial disclosure today to purchase a rental property, and my closing costs ended up being 6% of my purchase price, which is way higher than it's ever been. But a big portion of that is discount points towards the interest rate, because interest rates are absolutely ridiculous. But yeah, I do love that you pointed out all of the different pieces that are going into this transaction, which we covered a little bit in the home buying podcast episode. But basically, you're paying all these people, and the seller will have his own set of closing costs, his or hers, and the buyer will have their own set of closing costs. And you can share them. That is something negotiable. You can ask the seller, Will you cover this portion of my closing costs? And the seller can also say, hey, will you cover this portion of my closing costs? So remember that all of this is negotiable, but all of these people need to be paid nonetheless. Now, who pays it? You guys can talk about. So I really appreciate you going up with that. And where will people find, last question on closing costs before we move on, where can people find these closing costs, Casey?
So many of the costs are very hard to predict until you actually have a property identified. And that's because in most areas, the buyer doesn't choose the title and escrow companies. The seller usually chooses those. And usually, to be honest, it's the real estate agent who is listing the property that has chosen them. And their fees all vary. In fact, they all vary quite a bit. So again, very frustrating for consumers. They say, well, what are my title and escrow costs going to be? And I tell them, here's a wild guess. And it's probably somewhat close to the ballpark. But until you identify a piece of property and we identify who their title company is, an escrow company, and we contact them and say, what are your fees? We don't know. We're just guessing. So once you go into contract, however, as soon as you go into contract, you should get something from your lender called a loan estimate. And that loan estimate has to be a best effort estimate of, in good faith, of what your costs are going to be. And the lender costs specifically cannot change for the worse once you've received that loan estimate. The title and escrow costs could possibly change up to about 10%, but everything else is pretty well set in stone at that point.
Yeah, I love that. And by lender costs, guys, he's talking about the administrative fees, any discount points, your interest rate. Once these things are locked in, which you should always get them locked in, especially when you're within 45 days of purchase in most areas, these should not change. And if they do, then it might be a time to question your lender. Hey, why did this change? Did the lock expire? If it did, why didn't you ask me if I wanted to extend it, and things like that? So yeah, Casey, I love how you sum that up. I love it. So let's go into the different loan types, because Lord knows there are tons of different loans. So let's break it down to the basics. There's two separate types of loans. There's a fixed rate loan and an adjustable rate, a fixed rate mortgage and an adjustable rate mortgage. Can you quickly define both of those and kind of go over the differences between the two?
Absolutely. The 30-year fixed mortgage is easy, simple. Your interest rate is fixed. Your payment is fixed. If you make exactly the prescribed payment for 30 years, at the end of 30 years, you've paid it off. You could also get a 20-year mortgage or a 15 or a 10, and the shorter the term you ask for, the better your interest rate will be, and the higher your payment, of course, because you're paying it off faster. An adjustable rate mortgage means that the rate could potentially adjust during the life of the loan. Adjustable rate mortgages start off with a fixed period, meaning your interest rate is going to be fixed for a certain period of time. It might be 3 years or 5 years or 7 years or 10 years. Those are the common ones. And then after that, the adjustable rate, the interest rate could adjust. And how does it adjust? What a lot of people have in their minds is, so the bank can just decide what they want to charge me after 5 years, and that's scary. But that's not true. The way an adjustable rate mortgage works is that the methodology for determining your interest rate is defined in your note. So so you know what it's going to be when you sign your loan papers. And you should ask your mortgage advisor long before you get to go sign your papers, what the terms are. And as a matter of fact, in an adjustable rate mortgage, the terms are going to be spelled out in your loan estimate as well as in the closing disclosure. So you should know at least 3 days before you sign your loan documents what the terms are going to be. And the way it's determined down the road what your interest rate is going to be is with two factors. There is an index and a margin. And what do those mean? So an index is a measure of interest rates, current interest rates. So we all know what the Dow Jones is. The Dow Jones is a measurement of where stock prices are today. And just like with stocks, there are certain indices that tell us about where interest rates are on any given time. The most common index today that's used for adjustable rate mortgage is something called the secured overnight finance rate. And it's the rate at which banks lend each other money overnight to meet reserve requirements. That's all very complicated. You don't really care what all that means. What you do care about is that index tends to stay very low and be very stable. And then we take a look at the margin. So the margin defined in your note is how much they're going to add to whatever value the index is when you're getting ready to adjust. And the margin today typically is somewhere like 2 3/4%. I've seen some lenders at 3%. So you want to pay attention to this because it's going to impact your interest rates down the road. So let's say you have a 5/1 ARM, meaning it's fixed for 5 years and then begins to adjust every single year after that. Then at the end of year 5, they're going to take a look at where the secured overnight finance rate is. SOFR is the acronym for it. They'll take a look at where SOFR is. And let's say that SOFR is at 1.5%, as an example. And let's say that your margin is 3%. They take the 1.5, they add 3, you're at 4.5. Your new interest rate is 4.5%. The banks can't just make up the new interest rate. It's defined by your contract with them, which is the note, the agreement. So it's really important to understand that distinction, because generally over time, the adjustable rate mortgage will almost always be cheaper than a fixed rate mortgage. Unless, if we were 8 months ago and I was going to get you a 30-year fixed mortgage at 2.5%, you'd probably take the 2.5%.
Gotcha. Yeah, I love how you broke that down because I think adjustable rate mortgages, they get a pretty bad rap in the market, man. Everybody's like, oh no, after 2008, we saw what happened with all these different mortgage products, and everybody's afraid of them. But I love how you put the stigma out. Like, listen, this isn't a surprise. It's in your contract. At the time of closing, it's the prime rate plus whatever percent is disclosed. So
correct. And there's one more element too, for those of us who own multiple rental or multiple investment properties. When you're investing, you want to diversify your investments because sometimes some are going to do better than others. Think in terms of diversifying your debt. If all you have is 30-year fixed mortgages and the interest rates go down, the only way you can take advantage of the lower interest rates is to refinance. And there's costs involved in refinancing. Even if you do a no-cost loan, a no-point, no-fee loan, the cost is a higher interest rate than you would have gotten if you'd been willing to pay fees at that time. So why not, and this is what I do, why not have an adjustable rate mortgage and a fixed rate mortgage on your different properties? That way you've diversified your debt risk. When interest rates go low, it's usually because the economy isn't doing very well. So maybe you're having trouble renting out your place as much as you want, but all of a sudden your payment went down. And when the interest rates are going up, it's usually because the inflation is going up. And so, yes, you're usually full at that point in time, and your rents are rising. Your payment is going up on one of your properties, but your income is going up too, because rental income usually goes up during those periods. So I'm a big fan of diversifying my debt portfolio in the same way that I would diversify my investments.
Yeah, I love that, man. I told the story on either last episode or the episode before that, but I've actually, when I was shopping for mortgage products for this first purchase, I contacted a lender and their bank offered adjustable rate mortgages. But when I contacted her, I submitted my application. I was like, could you send me the 15-year and the 30-year fixed options? But could you also send me the interest rates and information for your adjustable rate mortgages? And she flat out told me no. She was like, "Oh, I'm not gonna give you an adjustable rate mortgage." And I was like, "Well, if you're not gonna give me all of the products that are available so I can make an educated decision as an investor, then unfortunately I can't work with you, because these adjustable rate mortgages could be a better option than the fixed rate mortgages." And she was adamant. She was like, "I'm not." And I just didn't work with her, unfortunately. And yeah, it sucks, man. But I mean, and I don't understand. I think that she had my best interest at heart. Seeing a 23-year-old kid buying another property, you don't want to mess this guy up, which I get it. I like to think of it. I like to think that her best intentions were up front with that, but it ended up, destroying any hope we had to actually do a deal. So
That's crazy.
it is crazy. And for the life of me, I just could not understand why. I mean, because I want to say I saw it either on their website or someone else's, but it was like a 5-year arm I could lock in for the first 5 years. It was like 3.5%. And with interest rates currently being in the 6s for investment properties, I'm like, you know what? That gives me 5 years to figure out my next step for this property. That's plenty of time to refinance or do whatever the case is, either sell the property or. So it was unfortunate, but it is what it is. I ended up working a way around it and finding someone else. But I always like to share that, because I think that it's very important, especially for when making a big purchase like an investment property or even your home. You need to look at every single option available to you and make a decision based on that.
Precisely.
So Casey, now that we talked about, and then I just want to clarify something you said earlier, because people might misconstrued it. You said for the fixed rate mortgage, your mortgage isn't going to change as long as you make that payment on time every time. What he's saying, guys, is your principal and interest will never change. That payment is fixed for the entire 30 years of the loan. It's amortized out, it's whatever. Your mortgage payment overall can still go up due to property taxes and insurance going up over time. So although your mortgage payment as a whole may go up over time, your principal and interest will stay the same no matter what, as long as you're paying on time systematically and you're just trotting along. So I don't want people to get misconstrued and say, "Oh, Casey doesn't know what he's talking about because my mortgage went up this year because my insurance went up $50 a month." It's like, oh no, that's not what he meant. Okay.
Well, and that's a very good point. I work mostly with investors who don't impound for taxes and insurance. So for my typical client, their payment will never change because they're not including that in there. But yes, if you impound, and by the way, most financial advisors will tell you you should never impound. You should keep that money in your investment portfolio working for you. I impound. I mean, I'm in the business and I impound my stuff. Why? Because I don't want to have to think about making the tax payment. I just want it made for me. So yeah, I could make a few extra bucks if I kept the money working in my investment portfolio, but honestly, it's not enough of a boost for me to bother with it when I can just simply make one payment every single month and the taxes and insurance are paid for. My 2 cents. Sorry, I'll get off the soapbox now.
No, actually that's quite interesting because I'm trying to wrap my head around why an advisor would suggest that, because at least most of the advisors I've spoken with, you don't invest money that you need within the next 6 months to a year. And property tax payment comes every single year. You don't know what the market volatility is going to be in that year. So I think that's assuming a little bit more risk than I'm accustomed to. I'll say that because I also escrow my taxes and insurance because I just don't want to have to deal with it. So I'm with you on that one, Casey.
I
So
work with a lot of engineers. I'm in Silicon Valley, and I work with a lot of engineers who literally they'll go over the top to try to optimize. They can make an extra $500 a year on there, they'll do it, and they might have $1 million in their stock account, but in RSUs or stock options. But if they can make $500 more by squeezing it a little bit, they will. And so I'm in an unusual area that way.
gotcha. And I
I'm
mean,
with
statistically speaking, the odds of you getting out ahead are still higher than the odds of you losing money, thinking about it, because there's been more up years than down years. But again, when you get a year like this year, it makes you kind of clinch up a little bit, man. But to
Exactly.
each his own, personal finance is personal. So, hey, so let's talk about, you touched on conventional loans a little bit earlier. And so I want to bring that topic back up because I want to talk about, so we talked about fixed rate mortgages and adjustable rate mortgages. You went over that absolutely eloquently. Let's talk about the three different mortgage types. I don't even know how to name them other than mortgage types. But what I'm referring to is conventional loans, FHA loans, and VA loans. I think those are the big three, besides like jumbo loans, which is out of my, I act my wage. So that's out of my wage. So can we talk about, let's just start with a conventional loan. You already hit on it a little bit earlier. What is a conventional loan and who dictates the parameters around that?
Okay, excellent question. And at its core, the difference is ultimately who is going to buy the mortgage, and therefore who makes the rules under which the mortgages are written. So you think if you go to Big Bank Inc. that they're making the mortgage out of their funds, right? They have all these people who have plowed savings into their bank. They've got a bunch of money in the vault and they make a mortgage out of it and they collect the payments. And that's true, they do collect the payments, but they sell that loan. And I think most people don't realize that. Probably 99%, 98, 99% of the loans made in the US are sold, even if you continue making payments to the same institution that lent you the money. So who buys them? It could be Fannie Mae or Freddie Mac, and they buy what we call conforming loans, what you think of as conventional loans. And all conforming means is that they conform to the guidelines that Fannie Mae and Freddie Mac have written. So these are two used to be private entities that are now part of the government, and their job is to buy mortgages from lenders after they've been made. So a lender makes 10,000 mortgages, wraps them up into a package, sends it off to Fannie Mae. Fannie Mae audits them, says, yep, these look good, and they send them a big check so that they can take that money and go make more mortgages. FHA and VA loans are typically bought by Ginnie Mae, which is another, and Ginnie is essentially derivative of government. So it's another separate organization, and FHA is part of Housing and Urban Development. VA is part of the Veterans Administration. So what FHA loans are is they're still purchased by the government, but they're insured. So there's an FHA insurance policy on each loan. In fact, there's It's paid for in two different ways. You alluded to it earlier in our interview. You talked about an MIP, which is mortgage insurance. It's essentially refers to an upfront mortgage insurance policy or premium. With FHA loans, there's an upfront premium of 1.75% of the loan amount that you can finance. It usually is, but it's still this rather large premium that you pay. And then in addition to that, you pay a monthly mortgage insurance premium. What that insurance policy does is, if, just like a regular mortgage insurance policy, if the lender loses money for any reason, then the insurance policy reimburses the lender for a portion of their loss. VA loan is different. It's a benefit to veterans. So there is an upfront funding fee. It's not a mortgage insurance premium per se, but there's a funding fee that varies depending upon what your current military status is, how many, and whether or not you've ever used your benefit before. So there, and it's a large fee. It can be a large fee, depends on your status. But there's no monthly premium, and with VA loans, you can get in with 0% down. Again, it's a benefit for those who have served, so it's a really good thing. The VA is a little different than FHA because it's not an insurance policy. The VA guarantees the lender, the ultimate investor, that they're not going to lose money. So the element that's missing here is, who is it really that they're insuring, since they're buying the loan, right? So they're actually buying the loan. So who are they insuring?
That's a good point, man. I'm thinking about that. Like, wait, they're insuring themselves?
Well, the answer is they have to get their money from somewhere, right? Fannie Mae, Freddie Mac, Ginnie Mae, they have to get the money that they purchase mortgages with from somewhere. Where do they get them? They get them by borrowing money through bonds. So they issue bonds, which is basically an IOU, essentially through the stock market, except it's not a stock, it's a debt instrument. And they're purchased usually by large institutional investors like insurance companies and pension funds and things like this. So a pension fund might say to Fannie Mae, I'll buy $100 million of that particular bond backed by that particular pool of mortgages. So the guarantees and the insurance are essentially protecting the people who ultimately make the investment in those by lending money to Fannie Mae, Freddie Mac, Ginnie Mae. Okay. And that's a little bit of a simplification, but that's who's protected. And that's one of the reasons why interest rates are as low as they are. Yes, I know right now they feel high, but when you take a look at what it would cost you to walk into a bank and take out a personal loan for 20 years, you'd pay through the nose. But you can still get a mortgage for a very, very low percentage point. Why? Because ultimately the people who are making the investment, who are buying the mortgage-backed securities, the bonds that from Fannie Mae, Freddie Mac, those people are well protected, that they're very unlikely to lose principal. They might not make all the interest that they think they're going to make, but it's a pretty darn safe investment.
Gotcha. And I will say I used the VA home loan twice so far. So that's another myth. Veterans can only use it once. You can use it more than once. Big myth. My funding fee for my first purchase was 3.3% of the purchase price, which might not sound like a lot, but guys, especially when you get up to $200,000, $300,000, $400,000 homes, it adds up. But of course, it was rolled into the loan. I still did zero down. And the second property I used with the VA home loan, I had no funding fee because at that time I was a disabled veteran. So if you are a disabled veteran with 10% or higher disability, then you get no funding fee for purchasing a primary residence with a VA home loan. Primary residence, primary residence, primary residence. Do not
Right.
try and go get an investment property with a VA home loan. That's mortgage fraud.
That's an excellent, well, first of all, two excellent points you just made. One is if you have a disability, and I've served several veterans who had disabilities, there is no upfront funding fee, which is fantastic. And the second is, yeah, don't commit mortgage fraud. It's just a really bad thing.
Federal crime.
It's a federal crime. I have people ask me all the time, can't you do this for me? It's like, no, because I'm allergic to jail and I like what I do for a living. I want to keep my license, and you're going to have to find someone else to do that for you. And also, if you commit mortgage fraud, not just for VA, but anything, if you commit mortgage fraud and it's discovered, your loan is due and payable right now. Your entire mortgage. And people don't, they go, well, okay, I'll refinance. No, you can't refinance because you're in default. Your loan has been called. You're in default. No one's going to finance you except maybe, Guido, who will break your knees if you don't make payments. So yeah, don't commit mortgage fraud.
Gotcha. So really quickly, another myth. We're going to go back to FHA for a second. FHA is not for first-time home buyers only. You can own a home and get an FHA loan. And I'm sorry, Casey, I know I might be preaching to the choir, but there's so many myths out there that, oh, well, I can't get FHA because I already own a home. No, that's not true. You can only have, in most cases, you can only have one FHA loan at a time. In most cases, there are exceptions. But you can own 30 homes, I assume, and as long as none of them are funded by FHA, then you can get an FHA loan for a primary residence. And Casey,
Yes.
Real fast, what is the lowest down payment for FHA loan?
3.5%.
3.5%. So if you're buying a $100,000 property, that is $3,500.
Correct.
And then for a conventional loan, what is the lowest down payment for that?
3%, as long as the loan amount is under 647,200.
Okay, and that's also for primary residences only. Is that correct?
Correct. If it's an investment property, Fannie Mae, Freddie Mac are going to require 25% down. I think you can do it with 20, but it costs more.
Yeah. I got 20 going right now because 25 was like, eh. And then, you know what? We're gonna keep it to the basics. We're not even gonna talk about second home mortgages, conventional, because that's an episode for another time, guys. And then I'm gonna go ahead and lump all of the other. So although these are the three main mortgage types, there are others out there. Okay, institutional banks are allowed to make their own mortgages that they do not sell, like Casey was talking about, and they hold the loan and they can make their own terms. So they can make a 10-day loan, and as long as you agree to it, they can do it. I saw one where it was like a 7-year fixed rate mortgage and then a balloon payment. But they're referred to as portfolio loans, but they're not being sold. Therefore, they do not need to abide by the rules of Freddie Mae, Fannie, Jenny, Marcos, and all those other guys that buy mortgages.
Correct. Although they still do need to abide by the rules of the CFPB, the Consumer Financial Protection Department. So and this would get off into the weeds, but there are a lot of things they can no longer do, period, that are considered toxic terms. So
would you just give like an example? Yeah,
a good example would be if it's your primary residence, they cannot put a prepayment penalty on it, nor can they use negative amortization, period. Except in the case of a reverse mortgage, but that's a special case.
Gotcha. Yeah, and I mean, that makes sense. Like, how dare you pay off your home early? Whew, Dave Ramsey would be pissed. Okay. All right, Casey. So let's go into how should a person prepare themselves when they're about to approach a lender to start the mortgage qualification process? What should they be getting together? Like, Nate, can you name off some documents, some things they may have, like, I don't know, a decent credit score? Like, what should they be getting together before approaching a lender?
That's a good question. It really depends, unfortunately, on the think about it is that there are three legs to the stool: credit, income, and assets. So let's talk about income. We need to document your income, and we need to document that specifically, and these words are exact. They're defined by the CFPB. Your income must be predictable, stable, and likely to continue. So what that means is we want you to have shown a history of being able to earn that income for at least 2 years. And we want to know that we can reasonably predict it's going to continue at least that level, and then it's likely to continue. So what does that mean? If you're a W-2 employee of the government and you've been there for at least 2 years, we need 2 W-2s from your last 2 years and the pay stubs that cover 30 days. And that's pretty good. We know it's not going to change. It'll go up a little bit every year. That's it. But if you're in sales, we're going to take a look at your commissions that have averaged over the last couple of years, because those are going to shift around. They're going to change. If you are self-employed, we need you to show us tax returns over the last couple of years to show that you've established an ability to make money consistently in your business. If you own rental properties, and you know this now, we have to have a couple of years of tax returns that show us you've established a history of being able to make money off of your rental properties. So that's the income. Assets, pretty simple.
Well, actually, Casey, before you go on, I actually want to ask you some questions about the income portion, because
sure.
I think you are scaring some people right now by saying this. So you said specifically, okay, I'm not even going to try and say what you said specifically. You said the income needs to be predictable,
stable, and likely to continue.
Okay, so with that being said, I guess, can you specify, because a lot of people may change careers within the last 2 years. For example, I'll just use me for example. I went from being in the military, government worker, W-2, salaried, to now working in the civilian world in a different sector. So seeing that, let's just say I was making 50 in the military and I got out of the military still making around 50. Those aren't exact numbers, guys. Don't call me. But seeing that pattern of income, is that enough? Or are you saying that it needs to be more specific than that? Does that make sense?
Makes a lot of sense. So you do not have to be, this is a myth, you don't have to be in the same job for 2 years. But we're going to look for continuity. So let's say in the military, you were a diesel mechanic and you get out of the...
You've been listening to the podcast? No, that was me. that was me. Okay.
So if you're a diesel mechanic in the military and then you get out of the military and you get a job as a diesel mechanic, no one's going to question that. You're trained, you know how to do it. You got paid doing it with one organization, and now you're getting paid doing it for another organization. But if you suddenly become an architect, well, how do we know that you have any ability to make money as an architect? Well, if maybe you just completed a 4-year degree in architecture, cool. That would help us establish continuity. We have a good example is one of my clients was a project manager for a major employer out here. I'll mention the name. And she went into corporate sales, from being a project manager to corporate sales, where she went from having a very high salary plus bonuses to a very low base salary plus commissions. And nobody would make the loan, even though she had great credit, she had good assets, but we had no way of being able to demonstrate or document that her current income was likely to be stable.
I love that, man. I really appreciate you clearing that up, because I know a lot of people got scared. They're like, wait a minute, I got to stay at a job for 2 years that I hate. No, guys, but there needs to be some correlation between not only the skills and experience, but also the income. So you can't go from, let's say you're a pilot in the military making $200K a year, and you come out to the civilian world and you fly a private little dinghy and make 10K a year. The income doesn't line up. So that's going to cause problems, even though the experience lines up.
Correct.
Okay, Casey. So now you can continue. So now we're on to credit. I'm sorry. I just wanted to be crystal clear on that point. Yeah.
No worries. No worries. Well, let me finish up assets first. Assets are actually quite easy.
Gotcha.
You need a couple of months of statements on your bank accounts. And the only thing that surprises people is, we think a dollar is a dollar. So if you have $100,000 in the bank, then you have $100,000 available. Cool, that's easy. What if you have $100,000 in the stock market? That's different, because until you liquidate that money, we don't know how much it's going to be when you go to close escrow, because it could be more and it could be less. And we also don't know if you have any taxable consequences when you liquidate it. Perhaps you have some capital gains. So what they do is they cut back until you've liquidated it, they cut it back. So they might take $100,000 and say, we'll give you credit for $75,000 as long as it remains in the investment account. And if you have retirement funds, as an example, if you're less than 59.5, they're going to reduce that by even more, because in order to access those funds, you have to draw them out, and you'll not only have to pay taxes, but you'll also have to pay a penalty. So they might typically use 65% of whatever you have in retirement if you say, I want to be able to use this. So assets are not quite as clean as people would think. Credit, it's pretty straightforward with credit. If we can take a look at your credit and tell whether or not whether you pay your bills on time. And it's a combination of the ability to pay your bills on time as well as the willingness to pay your bills on time. There's some people that are willing, but they consistently throughout their history have trouble making the payments. So we know that they don't manage money very well. And then there's people who are willing, or able, but they're not willing. So you'll see them they have a lot of money in the bank, and they still have terrible credit. And they have terrible credit because they don't get around to making the payment. They go, I'll make the payment when it comes to it. I'll be fine. I'll make the payment. And so we're looking for somebody who consistently makes their payments on time. Now, there's obviously different degrees of credit, and there's a lot of myths about credit scores, that sort of thing. I think it's terribly important when people first start thinking about buying a home, go to a good mortgage advisor, someone who understands credit, have them take a look at your income documentation, your asset documentation, and most importantly, have them run your credit. Almost everyone will do that for free without charging you. And we can see whether or not there are issues that can be addressed, because bad credit, good credit is not necessarily a yes/no decision in terms of whether you get a loan or not, but it could have a dramatic impact on the cost of borrowing. So I would address that as quickly as possible. And I've had clients that I've helped them raise their credit score by 40, 50, 60 points in a matter of a few days under certain circumstances, or by that kind of amount over 9 months or 12 months, if that's under certain circumstances. It depends on what the reason is for the low score. The sooner that you meet with someone, have them run your credit, do a baseline, the better off you are. And by the way, you do not need an 800 score to qualify for a loan. Anything over 740 with most lenders, 760 for others, will not only get you into the loan, it will get you the very best pricing possible. So these people who agonize over, well, I've got a 780 and I want to get up over 800, don't agonize over it. That's not your problem. Maybe you don't have enough money for your down payment. That's what you should be worried about. So it's really important, the earlier that you meet with a good, competent, ethical mortgage advisor, in my opinion, and I'm totally biased, I get it, but still, the sooner you meet with somebody, the better off you are, because I can tell you, should you focus on paying down your credit cards, or should you focus on stuffing money away for a down payment, or should you focus on getting your income up? I can look at your circumstances and tell you, and it's not the same for everyone. It's different for every single person.
I promise, guys, I did not pay him to say any of this. Casey, you don't understand. And we're going to go into this a little bit later in the episode, but you don't understand how much I love that you said that, because every single time I see someone say, oh, I can't afford to buy a home, I can't qualify for a mortgage, my first question always, have you gone to see a mortgage advisor? If the answer is no, then you are completely wrong about everything. Here's the thing. They want you as a client. So they are going to look at your instance and they're going to tailor you to become the best client possible. They're going to tell you, listen, this credit card right here, you need to pay that off. This collection, you need to call and settle that. This income, I need you to start reporting your tips more on whatever the case is. They are going to tailor you to be the absolute best client. So, and most of the time, I mean, I've never been charged for it, but it is free, like Casey said. So it's like, you can literally go to someone, they can tell you, this is what you need to qualify for a mortgage. And you go from being completely ignorant to having tactical steps that you can take on a day-to-day basis to buy a home. And like I said, I didn't pay him to say that. I've said that in past episodes. Like, look, if you haven't gone to talk to a mortgage advisor, then you don't know what you can afford. You don't even know if you can buy a home. You don't even know the minimum down payment. You don't know anything. You just have self-doubt. So Casey, I really, really appreciate you bringing that up, because so many people are afraid. They're like, oh, I don't want to go and get turned down. Like, yes, you might go in there and you might get turned down, but you're not going to leave empty-handed. You're going to leave with tactical steps. You're going to leave with more information than you came in there with. All at the cost of what? A credit pull, a hard inquiry. Like, that's it. That's all that you really pay for that. So yeah. And then I love how you pointed out that, like, your credit score in most cases is not a yes or no for the loan. It's just, how expensive is this loan going to be to you? How much do we trust you? If we trust you a lot, we're going to charge you less because we really want you as a customer. But if we don't trust you at all, we don't care if you walk away. So we're going to try and charge you the maximum amount we can. So.
Well, and the interesting thing is that the pricing that lenders produce every single day actually comes with a grid that shows you how much more you're going to pay based on your credit score and your loan to value. It says, if you are putting 20% down and you have a 760 FICO score, take this base pricing and it's zero. That's no add-on. This is what you pay. If your credit score is a little under, then you're going to pay an extra eighth. Or if your loan to value is 85%, you might pay an extra half. And if your putting 10% down and you have a 680, well, now you're going to pay an extra 1.5 points for the same interest rate. So it's very, very clear. It's not published. They don't distribute it to the public, but you can ask your mortgage advisor, show me the pricing grid here because I want to see how loan to value and credit are going to impact me.
Exactly.
It's literally
Jason.
published.
And it goes right back to, you want all of the information available to you. You want to know the interest rate on a 15-year. You want to know the interest rate on a 30-year. You want to know an interest rate with a 720 credit score. Unless you know your credit score, you know what ballpark you're going to be in. You want to know the difference between putting 20% down and 25% down. It's crazy because I'm literally, as we have this conversation, literally the past 2 days have been me communicating with 3 different lenders, getting all this information to figure out what the best mortgage option is for this property that I'm purchasing. So it's kind of like, I want to be humble, but I'm like brushing my shoulder like, okay, I'm doing something right this time. So I love it, man.
Now you sound like you've handled everything very professionally, exactly the way that I would want my client to do it. And a really good point to make here is I'm on commission. If we end up turning you down, guess how much money I make for the time I've invested? I don't get paid for it. I want you to buy a home. I want you to be successful in buying a home because I want you as a client 3 or 4 years from now when you go to refinance or sell that home and buy another one, or if you're a James Bowman because you're going to buy one home every single year for the rest of your life. Right? I mean, I want you as a continuing client, and I only get that by helping position you so that you're the most attractive borrower possible.
Yeah, it's literally like help you help me. And that's basically what it is. I mean, yeah. So it's kind of a no-brainer. So if you guys don't get anything else from the podcast, if you don't know if you think you can't afford a home, if you think that you don't have enough down payment to buy a home, if you have any negative thoughts whatsoever, and you have not gone to speak with a mortgage advisor, you need to go do it today. So Casey, all right, so let's say we gathered all of our documents, we got all of our assets, we got our proof of income, we've got you guys will take the credit. I go to a mortgage lender. What is the first step? Can you explain what the difference is between getting pre-qualified for a loan and pre-approved for a loan?
Yes, and that's an important distinction I don't know about today's market. Certainly up until the last month or two, it was very important. Pre-qualified means you've given me your documentation, I've looked through it, and I say, based on this stuff, James, we're going to be able to make your loan. But it hasn't been underwritten. Now, I've been doing this so long, I know what an underwriter is going to look for, but it hasn't been quote unquote approved. Pre-approval means that there's kind of 2 different levels of pre-approval. One is that we've taken all of your documentation, we've verified your income according to the standards of the lender we're submitting it to, we've verified your assets according to those guidelines, and we have verified your credit because we've run your credit, and we enter all of that information into an automated underwriting system, meaning that we throw it into this computer, the computer looks statistically at it and comes back with one of 3 answers. You're what they call approved eligible, meaning that you are approved and you're eligible for this loan. And the only conditions are that at some point a human underwriter has to review the documents and confirm that all of the data we entered in is correct. It could come back with a refer to manual underwriting, meaning, well, there's some stuff in here in the gray area, it's a little bit tight. We want a human to look this over and render a decision as to whether the lender can make the loan or not. And it's, and the decision is are we going to be able to sell this loan? to Fannie Mae or Freddie Mac or Ginnie Mae or to a Wall Street investment firm, whoever's buying this loan. And then a very rare response is essentially, yeah, no, don't give us this loan again. So there is a, ineligible essentially, where, but no professional mortgage advisor would bother putting that into the system. So it's extremely rare. Now so the automated approval is one level. If I have any doubts about how an underwriter might interpret income or assets or something like that, the current example is one of my clients has bonus income, but it went up dramatically this year. So normally the rule would be we would take the last 2 years of bonus income, and that's her bonus income. So 2019, 2020. Well, in 2021, she got this huge increase, which we can document. So what bonus income will they use? We know that they won't use today's current bonus income. They just won't, because we have to have a 2-year history of it. But will they take 2019 and 2020, add in what she's made for 2022 and average all of that? Or will they go back only midway through 2019 and use that 2-year period? That's judgment that's up to the underwriter. So I'm not going to use the automated underwriting system on that one. Instead, I actually sent that for manual underwriting. So I could actually ask the person who's ultimately going to make the decision, you tell me what you're willing to accept. So if it's been manually underwritten, that's rock solid gold. That means the person who's ultimately going to say, yes, we will do this loan, has actually looked over everything and said, yes, we will do this loan. And the only thing that remains is property conditions. You have to find a property, we have to get an appraisal and some inspections. That's it.
I love it, man. I love it. That's a great basic pre-qualification just is not as strong as a pre-approval. Pre-qualification is Casey saying, you know what, pretty sure we're good. But pre-approval is basically the underwriter saying 9 times out of 10, we're good as long as you're not trying to, spend outside your means.
Right.
So the last thing I want to cover before I get into Casey's dream client, can you just discuss debt to income ratio? Can you give a real explanation of that and maybe some pros or some ways to keep that manageable and low when purchasing a home?
So the debt to income ratio in its simplest form is total monthly obligations relative to your gross income, not your take-home income, but your gross income. So let's say, as an example, to use round numbers, you make $10,000 a month. Okay, that's your gross income. So $120,000 a year, $10,000 a month. Ultimately, we want your debt to income ratio to be under 43% of your gross income. So when we take, if you're buying just your first home, we take your mortgage payment, your principal, your interest, your taxes, your insurance, maybe HOA dues if there's, or mortgage insurance premium if they apply, plus any monthly debt that you have. We add all that up and it should not exceed 43% of your income. Now, there are exceptions. We can go up to 50%, but let's set that aside. You figure 43% is a good benchmark. So what are the ways we can control this? One way, of course, is by not buying too much of a home. The lower your purchase price, all things being equal, the lower your monthly payment is going to be. You can control it by putting more money down so that you can eliminate or reduce your mortgage insurance payment. You can increase your credit score if you have time, which would bring your interest rate down. And that could be a way of doing it. If you have a lot of credit card debt, and this happens a lot, then we can take a look at the credit card debt and determine which credit cards it might make sense to pay down or pay off And it could give us two things. One is it could eliminate some of the payment, which would improve your debt to income ratio. And it also could potentially improve your credit score. In fact, it almost certainly will. So as an example, if your credit score is okay, but your debt to income ratio is rough, is too tight, then what I might do is I might take a look and say, which of your credit cards has the highest payment to current balance ratio? And we'll give up some of the down payment and we'll pay that one off, because you're going to get the most bang for your buck in terms of the debt to income ratio by paying off the one with the highest payment with the same amount of money. We can also, we don't have to pay it all the way off. If you have less than 10 payments to go in order to pay it off, then we don't have to count that debt against you. So if you've got a credit card that, you know, the minimum payment is $100 a month and you owe $5,000 on it, we might pay it down to $900. And then there's less than 10 months and we can eliminate that $100 payment entirely from underwriting considerations. So it's a matter of the way that we're going to look at reducing your debt to income ratio to squeeze you into a loan will depend on your circumstances. Like I say, the easiest way is just pay a little bit less for the home.
Yeah, I love it. And I mean, there are other ways, even outside this home buying process that we talk about, like don't get a car payment. Okay. You don't need a car payment. Go get a cash card. It's not gonna have monthly debt. You know, credit cards. Casey's talking about paying them off to get a home. No, man, we're gonna pay them off before we even go for a home because we don't need that debt around. And yeah, I'm poking fun because I know everybody or most people are gonna have car debts and most people are gonna have credit cards, but just keeping your consumer debt lower going into the home buying process is going to keep your debt to income ratio lower, which is going to let you qualify for more home, even if you don't necessarily need that much home, if that makes sense.
Yes, and that's absolutely true. I have had clients who sold, like they had 2 cars and 2 car loans. I would just say, let's get rid of the car with the higher payment. Go pay cash for an old Honda Civic, something reliable, but that you don't have a loan on. And, then that'll make the difference. I also had one client that was somewhat funny because they really, 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 really wanted to buy a house. And the guy had a $30,000 Harley with a huge monthly payment on it. And when I said, here's the one way we can get you into the house that you want, he put his foot down and just started screaming at me. Absolutely not. It's like, okay, you don't want a house that bad.
I was going to say, life is all about choices. Which one do you want more, a Harley or a house? Where are you going to park the Harley at, buddy? Okay.
They started fighting and I never saw him again.
Yeah, man, you tell a man to sell his motorcycle, Casey, and that's an easy way to get under his skin.
Exactly.
All right, Casey. So let's close out the show because we threw a lot at the listeners and it's going to be a lot to process. But I want to get down to your ideal dream client. Let's say you're sitting at your desk, right? It's Monday morning, 9:30, got a cup of coffee in your left hand. And let's just say you're looking at interest rates on your computer. And boom, your assistant comes in and say, Casey, I've got the perfect client that just walked in. What would that client look like? Let's start with their credit score. What would their credit score look like?
Well, anything over 680 is easy to work with, but anything over 740 means that I can get them the best pricing. But anything over 680 is very easy to work with. I can do loans for folks with scores as low as 620. We have the products for it. But I will tell you this, everyone that I've ever worked with, not everyone, there's a couple of exceptions, but for the most part, people with scores under 680 are not really ready to buy a home.
Ooh. All right, Casey, you gonna get some backlash for that one.
I'm
on the same. No, but hey, we're on the same page on that one. But you said it out loud. I didn't.
And I will take the hit on it. I think if your score is that low, you probably need to improve your ability to manage money.
You need to, I like to call it secure your financial footing, you know.
Perfect. I love that.
Yeah, because I think Dave Ramsey has a saying, you know, or he says something along the lines of like buying a house can either be a blessing or a curse. And when you don't have the footing, it becomes a curse. So coming in with a very secure financial footing is going to make your house a blessing, not a curse. And although not 100% of the time, but let's just say 95% of the time, if your credit score is like the 680 and below, there's something hindering your secure financial footing.
Right.
I think that's
exactly. And it's almost always your behavior in the past. So just last fall, I had this great client who had a 667, I want to say. But everything was in the past. She had no bad credit for the last 2 years. She got a stable job. She stopped partying. She started saving money. She got her father involved, and her father was sort of helping her, coaching her. And she was coachable. She was totally, completely coachable. I worked with her for a year, improving her credit just to get it up to 667. And helped her out and coached her. She was listening. She did everything that she was asked to by her dad and by me. And we got her into a house. And I think she's going to be successful. I don't think she's going to lose the house. I think she's fine. That's what's important to me. I don't want to put someone in a house and find out a year from now that they've lost it. I just don't. You know, that would be a horrible experience for me.
Yeah, and a part of that is buying too much house. You know, there are mortgage advisors out there that, you know, the bigger the loan, the bigger the commission. And so they want to give, some of them want to give you the biggest loan allowable that your debt to income would allow. But there are also good ones that'll say, okay, even though you can qualify for a $300,000 home, you know, in this market, it's just you two, maybe one kid, you can settle for a $150,000 home and be in a much more secure position. But that takes a real, I'm going to use the word, that takes a successful mortgage loan officer, mortgage advisor. The ones that are not as successful, they need the money more than they need your future business, if that makes sense.
It does. There's nothing worse than a combination of a real estate agent and a loan officer who are both desperate for the next commission.
Mm-hmm.
You don't want that.
Yep.
And most, by the way, I should frame that. Most realtors I know are very high integrity, smart people who care about their clients. Most loan officers that I know are high integrity people who care about the lending that they do, because they care about we're in it for the long term. We're not in it for, I don't care how much money I make this month. I have a professional practice to protect. So just to speak to what you're saying is, yeah, look out for the ones who are just trying to get commissions.
Yeah. And once you got a good one, don't let them go. I've used the same real estate agent for 3 of my purchases. This is the 3rd one. And I've used this same lender. This is the 3rd time I'm using the same lender. So it's working out. It's working out. I know they have my best interest at heart.
I love to hear that. That's awesome.
Okay, so we talked about credit score. What about the ideal work history, Casey? And let's go employed, and let's also go self-employed, because I know there's 2 sides of the coin there.
Well, employed it's easy. I just, ideally you've been doing the same function or working for the same company and having a natural progression. Like if you were, if you were a machinist and then you went up into being a shop manager, something like that, that's all fine, right? In my area, you get I work with a lot of 30-year-old software engineers who go from software engineering to a manager engineer to a director of engineering. It all makes sense, right? So you want 2-year history where at the very least it's been stable. So that's ideal. Self-employed is a little bit different. In theory, no matter what your business is, we should look at it the same way. So whether you own a retail store or whether you own a real estate brokerage or whether you sell fruit on the street corner, that shouldn't matter. All that should matter is what has your net income been the last 2 years. And we do look at the net income. So if you're self-employed and it's an individual, you're filing a Schedule C, we take a look at the net income that you reported to the IRS. So people say, well, I write a whole bunch of stuff off, but we can add back in depreciation. But if you're writing off your toilet paper, there's nothing we can do about it. You're writing off your toilet paper. You're trying to minimize your taxes, but by doing that, you're minimizing the amount of income that you can document. So we do take a look at your history. Having said that, underwriters are humans. So they are going to take a look at the stability of the kind of business that you have, and they have their prejudices. To be perfectly frank with you, it's hard to get a mortgage if you're a realtor or a loan officer, because our income goes up and down so much. During the refi boom, every loan officer was making insanely good money, no matter how professional or intelligent or competent they were. It didn't matter. This year, all of us, our income has gone down. So it's harder for us to get a loan just because the underwriter knows that our income is highly variable and they're going to be looking for that. So really, we're just looking, if you're self-employed and it's a conventional loan, we're looking for stability in your net income and hopefully an increase. Like, let's say that you have $100,000 gross income and an $80,000 net in 1 year, and the next year it's $110,000 gross and an $85,000 net. That's a good trend. But if you have $100,000 gross and an $80,000 net the first year, and then the next year you have a $90,000 gross with an $80,000 net, you might have some explaining to do. Okay, how did you reduce your expenses? The underwriter might actually ask those questions. Or if you had a $100,000 gross and a $95,000 net, so all of a sudden you have the same gross as before, but you have 1/4 the amount of expenses. We're probably going to have to explain how that happened. Maybe you laid off a couple of people because you figured out that you could make as much money doing it on your own. Cool, that's fine. That's a good explanation. But we have to look at that circumstance and ask the question, is it predictable and is it likely to continue? We know it's not stable because you're self-employed, right? So nobody who's self-employed has a stable income.
Exactly.
Right? I mean, they don't.
Gotcha. And so I'm just going to assume that if the underwriter sees a trend down in net income, then that's also probably not a good sign for them if they can't explain it.
Right. The rule is we take a look at the last 2 years and we use the average over 2 years if it's stable or increasing. If it's declining a little bit, we just use the last year, the lower of the 2 years. If it declines a lot, chances are really good that they're going to turn the loan down.
Gotcha. Okay, and then the last one is the ideal amount of, and you don't have to give a specific dollar amount, but maybe like percentage wise or for liquid cash and assets that they're bringing to the purchase. Like, what is the ideal? What do you guys like to see for that?
Well, 20% is the benchmark, but honestly, it doesn't get harder until you're only putting 3% down. Because it's insured, because we have mortgage insurance, the lender's protected. As long as it all makes sense, as long as the numbers still make sense, they're fine with it. So with 3% down, they get a little bit more cautious. But with 5%, 10%, 15% down, they're pretty much good with that. But remember, in addition to your down payment, you got to have enough for closing costs. And also, people don't think about this. We don't want you to be flat broke and busted when you close. You got to still have some money in the bank. How much money? Typically for conventional loans is we need you to have 3 months of housing payments in the bank. So if your total housing payment all in, principal, interest, taxes, insurance is going to be, let's just say $3,000, then we want you to have at least $9,000 liquid left over when you close in the bank.
Gotcha. But that can also be in the form of assets like stocks, or even though they will not weigh them dollar for dollar. Is that right?
As long as it's liquid. And in many cases, in some cases anyway, we can use a reduced value of your retirement fund. So if you have an IRA or 401k, we might be able to use 65% of that. The idea is that we want you to have access to something in an emergency.
Gotcha. And then just to clarify for the listeners, that's 3 months of just your housing payment, not your entire debt obligation that went into your debt to income ratio. Is that correct?
That's correct.
Gotcha. Just want to clarify because some people might be, whoa, James, I don't have that much. Casey, you're crazy. Okay. And then just a question for the streets, because I don't know, just pick your brain. Do low down payment options, do they go away the higher amount of liquid cash someone has? For example, let's just say Joe Schmo, let's say he won the lottery, but he kept his job and he's buying a house. He's got $1 million in the bank. Is he able to do a 3% down conventional loan? Or are they going to be like, you have the money, buddy, so I want the full 20%?
He can absolutely do 3% down.
Gotcha.
Now, as a mortgage advisor, I would want to ask why. But some people have perfectly legitimate reasons. One client that comes to mind was buying a triplex with an FHA loan. He was going to live in it. It was going to be owner occupied because you can't do an FHA loan on an investment property. So he wanted to get in with a low down payment, and the only way to do that was with an FHA loan. So I asked him why, and he said, because I want to have cash left over to buy another piece of property later on. So I said, you're going to tell me, he was renting, so it was his first piece of property. I said, you need to tell me that you really intend to live there, because if you don't, I'm not doing this loan. He said, I absolutely am going to live there. And it made sense. There was 3 units. One of them was an owner's unit. So he was going to move into the owner's unit, rent 2 of the 3 rooms out, rent the other 2 units. And eventually, ultimately, he would probably buy another house and that. But in the meantime, it made sense. He wanted to retain his cash, 1, to keep it working in the stock market, and 2, so that he could use it at some point to buy another house.
Yeah, I feel that one, man. I might know someone who might have did that with a VA home loan, where he got a VA home loan and he put 0% down, even though because he wanted to keep the cash to buy another rental property, another investment property a couple months later. Yeah, and it worked out. But yeah, anyways.
Would his name be James?
No, of course not, man. Of course, maybe. Okay.
It's a perfectly valid reason to do that.
Yeah.
And yes, you can.
Yeah. I just want to clarify that for people who still have the options of the FHA or VA or even low down conventional loans if you plan on living in the property. That I got to keep specifying that, because I don't want nobody going to court on felony charges and say, hey, Casey said I could do it. Heard it on the Gen Z Money podcast, because we're not going to help you, buddy. We're not going to help you.
Exactly. I'm not posting bail for you.
Yeah.
But I think it's important to also say here, don't hold back on how much assets you have when you talk to me. I'm on your side. My goal is not to pull as much cash out of your account as I possibly can. And if you have a lot of extra cash, it makes you a stronger borrower. And I have people that hide cash, like they'll have two accounts with just enough to do the deal. And they do it because they think if they show me more cash, I'm going to find a way to make them spend it. I make exactly the same percentage on every single deal. By law, I can't make any more, I can't make any less than a percentage of the loan amount. And it's the same percentage every single time, no matter what interest rate I sell you, no matter whether I do a 5% down or a 10 or a 20 or a 25 or a 50% down, whether I sell you a 30 or whether you choose a 30-year fixed mortgage or an adjustable rate mortgage, I make the same amount. I have no agenda to try to take all your cash. But if you have a lot of extra cash, it makes you a much stronger borrower. It makes it a lot easier to get your loan through the system quickly.
All right, Casey. Hey, I think you're reading my mail, man. So then let me just ask you this. I'm just gonna put my business out there. It's because so for example, for the current loan that I'm doing, I submitted bank account documents that had more than enough cash in those bank accounts to support the purchase, reserves, and all that. But as a doomsday prepper and a survivalist, I must say, I have multiple banks, right? So I have like, let's call it 3 different banks. So if I have a bank account over there that's got money in it, I don't have to disclose it though, right? Because like if I disclose it, I just think that it's just another statement I have to submit every month to the. So like, is there anything against the law or that I don't disclose that extra money on top of the qualifying funds? Does that make sense?
No, it's fine. You have to disclose all of your debts, but you don't have to disclose all of your income or all of your assets. So if you have a part-time job that you've had for a couple of years where we could count that income, but we don't need it, you don't have to disclose it. If you receive child support or spousal support, you can use that to qualify as long as it's going to continue for at least 2 years, but you don't have to, right? So, but with your debts, that's the only thing. If you've got a debt, you better disclose it.
Gotcha. And I just want to clear the air because I'm not trying to hide the money. It's literally just a hassle factor thing. Because you have to submit bank statements, and that's just another bank that I have to, and it's a lot of work, man. I'm lazy.
Sure. No, absolutely. And actually, to be honest with you, it's simpler for us. If you've got 2 accounts that contain enough assets for everything we need, I'm perfectly happy. Especially, and I don't know why people do this, but I have some people who they'll send me statements and they've got a bank account that they sort of forgot about that they've got $200 in. And they give me two months worth of statements. And I just go, can we just leave this out?
Yeah. Okay. So you know what? I'm doing my mortgage lender a favor because now if they ever say like, hey, we need some more proof of funds, then I have it there. But it's like, I don't think it's going to help my approval odds because I am already pretty highly approved at that point with the funds disclosed. So yeah, I think I just thought you were reading my mail when you brought that up, man. But Casey, man, this has ran pretty long, but it's been so informative. I mean, all of the information that you brought to this conversation, I really think it's going to help people get qualified for because you could tell people how to buy a home all day, but if they can't qualify for a loan, they're not going to be able to tactically use any of those steps. So I really think so many people are going to get so much information out of this and tactical steps they can actually execute on starting the day this releases, man. So I really appreciate you coming on.
Oh, you're very welcome. This has been a great interview. You clearly know what you're talking about, and I love that. I've been on a lot of interviews where somebody was just sort of, well, I don't really know anything about this. It's nice that you were well prepared and that you know what you're talking about because it does make the conversation flow well. So thank you.
I appreciate that. I've been through it a couple times, but I'm no expert. I know enough to get by. That's what I like to say. But Casey, before you leave, man, tell our listeners where they can find out more about you.
So my brand is Loan Guide. My website is called loanguide.com. And it's a URL I've had now for 23 years, I think, a long time. And it's essentially just a lot of informational posts. I published a book in 2014 called The Loan Guide: How to Get the Best Possible Mortgage. That book is on Amazon. I'm going to be really honest with your listeners. It's a little dated. The analytical information in the book is still fine because those, math doesn't change. But some of the descriptions of loan programs and everything else have changed since 2014. I have my second book is coming out. It's called, what's it called? It's called Buying and Financing Your New Home. And it's actually been picked up by Morgan James Publishing. So it will be not just online, but in bookstores and in ebook form. It should come out in August. That's our target. Could be September. We'll see. But very excited about that book. It's much more focused, and it really addresses why buying a home is a great idea, and how it helps you build wealth for your family. So that's how you can reach me. The website is super easy if you want to learn more about me and reach me. It's really easy to do through that. I am licensed in California only, so I do loans only in California. I am with Fairway Independent Mortgage, which is a nationwide company and the third largest mortgage lender, I believe, in the country at this point. And we do have offices and branches everywhere throughout the country.
Awesome. And of course, guys, you guys are not going to have to go far. I'm going to have both books linked down in the show notes. I think this show is going to come out before your second book, but I'm going to reach back out to you and make sure I get a link to that. That way people can purchase it and support you in that way. And of course, guys, I'm going to have all of this website contact information down in the show notes, so you won't have to go very far to find that stuff. Casey, this has been, honestly, it's been such a pleasure having you on, and hopefully I can have you on in the future, especially after this next book comes out, so we can dive even more into this if you want to. This is such a great topic.
That's perfect. Thank you so much, James. It's been a pleasure.
All right, great. Casey, you have a great night, man.
All right, you too.
And guys, that was me and Casey going over the entire mortgage process to purchase your first home. Guys, we talked about your credit score and how that impacts your loan, your work history, income sources, your debt to income ratio, having cash for clothing, having reserves. We go over so many different things that hopefully can help you guys prepare to purchase your first home. Now, I know some of you saying, James, hold on. That was a lot of information. That is a lot to prepare for. That's a lot to take in, and I 100% get it. But when you're able to break it down into bite-sized steps, right? First thing you need to do, you need to go ahead and start fixing your credit. Once you fix your credit as much as you can, now you need to worry about, getting your income stream stabilized. So breaking it down into simple bite-sized steps is what's going to get you to buying your first home. And it's not going to be easy. They're going to ask, what size shoe did you wear in the third grade? They're going to ask so many different things to get you qualified, but understand you're buying an asset, and you're not, when you're buying a liability, they don't care about if you're able to pay it or not. It's a liability. When you're buying an asset, guys, this is where you need to pour in all of your hard work, hard earned sweat, tears, and everything. So I really hope you guys enjoyed. I really hope that this was very clear and it clarified. I hope I asked some clarifying questions that maybe you guys might have had. But of course, if you guys have any questions, you can always reach out to Casey. His contact information is going to be in the show notes. You guys can always reach out to myself. You guys know where to find me on all social media. So If you have any questions, do not be afraid to reach out, because we know that it can be a very, very, very overwhelming process. But without further ado, guys, I really hope you guys enjoyed me and Casey's conversation. I hope you learned from it. Of course, you guys can find me on all social medias down in the show notes. All of Casey's information and his book are going to find you. His new book, too, coming out is going to be down in the show notes. So I really hope that you guys enjoyed it. I am your host, James Bowman. And always remember, you're only as secure as your ability to perform. So spend your life accumulating assets that can perform for you. Later, guys.